Gap trading like a pro, step 1. Gap trading like a pro, step 1. Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders. And our website is www.stochastic-macd.com, www.dayprotraders.com, www.24a.waves.com. The title of this video is Gap Trading Like a Pro, Step 1. Okay, during the first step of this gap trading tutorial, we will be talking about the author of the gap. All right, in other words, the participants of the gap. All right, the market participants that creates the price action gap. All right, so we want to know who are the market participants that are likely to create a price action gap. All right, we want to know who are the people who can create a gap. So talking about a gap trading, we want to know first, all right, who are the author, the origin, the source of the gap. All right, this is very, very important. So you may understand already, how to trade a gap. But when we clarify now to you who are the author, or the source of this gap, you will understand more how to trade a gap. That's why this is step 1. Now, some traders may think, George, why do you need to record a video like this? I want to explain to you. When you are trading, for instance, a financial instrument, any financial instrument, whether stock, commodity, all right, you want to know, the market participants that are involved in that kind of trade. So professional traders that are trading gold, no market participants that are trading gold. So what you are doing, you want to keep your left eye on these traders to see or to get into their mind to know exactly what they are likely to do, how they trade, and the tool that they are likely to use. It's very important in the market to know what other traders are doing, and if especially you are trading the same financial instrument with these traders, you want to know who they are and how they trade, their trading style, their trading tool, and what time of the day, what time of the year they come into the market. This will allow you to make excellent decisions. All right, so it's very, very important. So to know the market participant, the price will not gap up, the price will not go up or go down, the price will not gap down without a market participant. So when we see a gap, we want to know who are these people. So that's the first question. Who create this gap? What kind of market participant create this gap? So in this tutorial, it will become clear to you, the market participant that are constantly creating, gap in the market. So if we know the type of market participant that create a gap, we can make better decisions. So we want to go into their mind, how they trade, how they come into the market, and so we can trade the gap accordingly. Without the gap will be a continuation gap, exhaustion gap, all right, or opening gap. So you will understand clearly that this is an opening gap, this is a continuation gap, this is an exhaustion gap. So stay with me and watch the full length of this video, so you may understand clearly, gap trading like a pro, step 1. Let's get started. The first culprits, for gap creation are high-frequency traders. All right. So high-frequency traders are the number 1 market participant that create price action gap. So you will see sometimes market is open, especially New York is open, and you see some stock that gap up. All right. And most of these gaps are short-term gap or speculative gaps. So what usually take place, how high-frequency traders trade, they are trading on a lower time frame, 5-minute time frame, 1-minute time frame, 10-second time frame, all right, concentrating on a short-term trend. These trades are taken by computers. So if you want to know more about high frequency trading, go to www.stochastic-magic.com, click on high frequency trading, all right? And you will understand more about high frequency trading. So these short-term speculative traders, which we call high frequency traders or HFT traders, HFT firms, these are firms that use computers to trade. So these are automated trading methods that they use, automated software that they will use, okay, to come into the market to place a trade. And sometimes just before, okay, New York is about to close, in the last 5 minutes, okay, or when London is about to close, in the last 5 minutes. But the most important time you want to understand for high frequency trading, when New York is about to close, all right, these high frequency traders will place a trade. So their computer will take the last trade of the day during the last 5 minutes before New York is about to close. All right. So as this trade is taken, all right, the trade is left open. Okay. So the next day, all right, the price will gap up. So if many high frequency trading computers, for instance, okay, have bought, okay, the euro dollar during the last minute before, okay, the forex market is closed on Friday at 10 p.m. London time, and then it's the weekend time, and then Monday, you are likely to see that the euro dollar may gap up. This is a speculative gaps that are created by high frequency traders that are, okay, in fact, these are computers that take a last trade during the last 5 minutes before a market is about to close. So if many high frequency traders took a bullish orders 5 minutes before a financial instrument is closed, the next day that financial instrument has a high chance to gap up. The opposite is also true if high frequency trading computers, okay, are selling a financial instrument. For instance, they are selling Apple stock in the last 5 minutes, and this will create what we call a kind of short-term distribution. So then, as the market is closed, all right, because these trades are taken at the last minute before the market is closed, the next day, okay, you will see that the price may gap down because these are high frequency trading computers selling a specific financial instrument in the last minute before a market is closed. All right? Does it make sense to you? Okay, so high frequency traders are number one, okay, creators of a price gap, but they are not the only, okay, market participants that create gap. All right, but you have to understand that the gap that the high frequency traders are creating, these are speculative gap that are likely to be filled. Okay, I will talk about it in part 3. Okay, so if you want part 3, I will explain to you more why it's a speculative gap, why the gap will be filled. Okay, so the next, okay, next group of market participants that create price gap are Elliott wave traders. You can clap for us. Okay, myself, I am an Elliott wave trader. All right. If you want to know more about Elliott wave trading, go to 24elliottwave.com, digit 2, digit 4, elliottwave.com, or subscribe to 24 Elliott Wave YouTube channel, okay, to know more about Elliott Wave. The Elliott Wave traders can create a gap in the market. Why? Because they are reading the market, they are reading the price, they are interpreting the price, they are forecasting the next price move. So, for instance, if we see that, okay, a pattern is completed, all right, and all Elliott wave traders have noticed that, okay, pattern, and they all buy together, that can create a gap the next day. So you have to understand that there are Elliott wave forecasting, okay, services out there that a lot of banks and hedge funds, okay, employ. So these are, okay, Elliott wave forecasting services. One of them, Elliott wave International. These a lot of big, okay, financial institutions, okay, refer to this Elliott wave forecasting business to forecast the next price move for them in the financial market. So if, for instance, we see an Elliott wave traders see a pattern that is completed and it's a bullish pattern, they are likely, okay, to buy, and this can create a gap in the financial market because you have a huge group of market participants, including the bank, the big institutions that are using Elliott wave forecasting services, or that are using Elliott wave forecasting software, that have noticed that now, this is the end of ABC correction. After an move, they all buy together. You are likely to see that the following day or the following week, the price may gap up. So this concentration of buying or selling activity by the Elliott wave trader can create what we call accumulation or distribution that can also generate a gap up or a gap down depending on they are selling or they are buying. So Elliott wave traders can create gap in the financial market. The third group of market participants that can also create a price gap are fundamental traders. You need to know that, my friend, because I believe most of the traders are technical traders, but they don't know that there are other market participants that do not care about MACD or stochastic, but these are fundamental traders that go to Google Finance, Yahoo Finance, Forex Factory, analyzing, the fundamental to make decisions. And these kind of market participants, which we call fundamental traders, can also create gap in the market. And you need to be a little bit afraid of these fundamental traders. Why? Because sometimes the activity is quite hidden. So they are buying gradually, and no one knows that they're buying unless you are also checking the fundamental, the financial, the balance sheet, the cash flow, doing your due diligence like a fundamental traders. So they may be buying a financial instrument because the financial instrument is oversold, looking at the book, the fair value, and they are just buying it because of that. And at one point, due to these accumulation that are hidden, secretive activities that are going on, one of the fundamental traders is a mutual fund, hedge funds are fundamental traders, and so they are buying gradually, and this can create also a gap in the financial market. The fundamental traders can create what we call long-term gaps. You need to understand that the fundamental trader can create long-term gap. They are the number one creators of the opening gap. All right. They are the number one creator, the fundamental, if you want the footstep, if you want to, how do we say it? The footprint of fundamental traders, the number one footprint of fundamental traders is the opening gap. When we see the opening gap, we need to check the fundamental and dig into it, why these market participants are buying or selling these financial instruments. So the bullish opening gap will force us to check the fundamental, because the fundamental trader very often will create what we call the opening gap, during the first Elliott wave, all right? So fundamental traders can create a gap. They are checking the fundamental and they are buying gradually, creating what we call accumulation that will propel the price to gap up during the first Elliott wave. All right. They can also buy during the third Elliott wave, and also they can also sell at the end of the fifth bullish wave. They can also buy at the end of the fifth bearish wave. All right. Fundamental traders can also create a gap. I will come back to that. In part 3, So, talking about fundamental traders, hedge funds, banks, mutual funds are fundamental traders. Typical fundamental traders, hedge funds, bank, mutual funds are fundamental traders, all right? Another group of market participants that creates the gap, so this is just a combination of different type of market participants. This is what we call the first players and the last players. Stay with me, all right? Stay with me, all right? It's not a difficult word. The first market players and the last market players, So for traders that are following us at 2-4 Elliott wave, we know that the first buyers are the creator of the trend. So when we see a bullish trend, price going up, we have a clear-cut bullish trend. We have always what we call the first buyer. There is always a group of traders that know that, this financial instrument is due to go up before the majority of market participants. These are the first buyers, So they just keep buying. They keep buying because they know that this financial instrument is due to go up before everybody else. So they just keep buying, or if they are selling, they just keep selling, keep selling. These are the first sellers. And these type of traders can create, okay, can force a financial instrument to gap up or to gap down, depending on their buying or their selling, okay? There is another group of market participants that can also create a gap. This is what we call the last players, okay? So it's not a difficult word, last market players. Now, it's a general group of traders that are late all the time in the market. So a trend is going on, so an uptrend is going on. As the trend is about to finish, okay, these people will now believe that, oh, of course, it's going up. So when a trend has begun, they are sitting on their hand. They say, I don't believe in this trend. It's going to go back down. It's going to go back down. But the trend is going up. And then when the trend is about to end, talking about few weeks left for the trend to finish, these people will now join everybody and buy. These are the last players. Or if a financial instrument is going down, okay, these last players may just sit down and wait and say, now, no, it's not going to go down more. It's going to finish now. It's going to finish now. But as the downtrend is about to end, few minutes left, few hours left, few days left, few weeks left, few months left, the bearish trend is about to end, they will now come in, okay, and sell. And these type of traders can also create, okay, a price gap in the market, all right? So we don't want this video to be too long. Gap trading like a pro step 1 is about knowing the market participant that create a price gap in the financial markets. Okay, the first market participants that we were talking about before are the high frequency trading computers or high frequency trading firm, high frequency traders. Okay, the next group of traders that can also create a gap in the financial market are Elliott wave traders. Due to Elliott wave forecasting, they can predict the next price move, and by buying before everybody else, these group of traders, okay, talking about accumulation taking place together due to Elliott wave forecast or distribution taking place due to Elliott wave forecast, this can also create, okay, price gap. We also have the fundamental traders, which is very, very important for market participants, whether you are technical traders, to remember that fundamental traders can create gaps in the financial market, and their gap can be hidden, and suddenly, boom, up, the price will gap up, okay? Recently, we see a fundamental traders gap, all right? Talking about the fundamental traders as a hedge fund, bank, mutual fund, remember that the bank, the hedge fund, the mutual fund can also trade when the market is closed. So sometimes market is closed, you say the market is closed, but these players can trade. They can even trade on Saturdays. So these activities that are recorded, okay, these order that are placed when the market is closed, can also create the gap the following day. So the market is closed, earning news is released, these fundamental traders, bank, hedge fund, mutual funds still buying or selling, and the next day the market open, price gap up, price gap down, because the fundamental traders, okay, can trade outside the opening time of a market. Even sometimes on Saturdays, they are allowed to trade. My friend, remember, these fundamental traders can also create price gap, okay? Apart from the high-frequency trader, Elliott wave trader, fundamental trader, which are hedge funds, banks, mutual funds, we have what we call the last players and the first players, all right? These are the first buyers or first, okay, sellers that can create a gap in the financial market, okay? We also have the last players, which are last buyers or last sellers that can also create a gap in the financial market. This is the end of this video about gap trading like a pro. Step 1, knowing and mastering the market participant that can create a gap price action or price gap in the financial markets. All right. We can also mention about last-minute bull and last-minute bearish traders that place a trade few minutes before the financial market is closed. So you will see some. This is what I say to you. A group of traders may, for instance, trade the USD yen or a particular stock, You know, some stock, there are only few people that trade them. Okay, so last minute, this kind of speculative trader may go and buy that stock that not many people are trading, or for instance, okay. So last minute, they buy, the next day, the financial instrument will gap up, okay. So these are the last minute bullish and bearish traders can also create gap in the market. So some stocks that are traded by, a small group of traders, these traders, if you know how they trade, you may also profit from them, which means you last minute before the market is about to close, they will quickly place a trade to buy or to sell, forcing the financial instrument to gap up or gap down the following days. Okay, so these are some short-term distribution or accumulation taking place last minute before a financial market is closed. All right, this is the end of this video. And if you like this video, okay, please give us the thumbs up. If you dislike it, make sure you give us the thumbs down. All right. If you have any question, or put in the comment section. No spamming, please. All right. And you have any suggestion, okay, put it in the comment section. And in due course, we will record another video to answer your questions. If you love, this video, feel free to share it on Google+, on Twitter, and also on Facebook. If you love our videos, you say this is the time to subscribe to our channel. Check the description section. There is a link right there. Just click on it to subscribe to our YouTube channel. We wish you the very best in your trading, and until the next time, enjoy yourself and be very happy. See you in part 2, when we will be talking about gap trading like a pro, step 2. This time we will be talking about the factors that can create gap in the financial market. So in the first part, we were talking about the market participant, human beings or machines that create the gap. In the second part, we will be talking about factors, that the causes, of a price gap. See you in part 2. Thank you for watching. And we will speak to you very soon. We are the TSTW at 24 traders talking about gap trading like a pro, step 1. See you in part 2.